Good day. Ira Epstein of Linn Associates with your financial market wrap-up for this Monday. We're at the 23rd of September, 2019, and I think it's fall. They did tell me, I know when I woke up this morning on the news, don't set your clock yet. Okay, I'm not going to. As we take a look, though, at the marketplace, you can see a nice gain in U.S. stock indices, and that's in part because of the early reports that came out of Europe where their PMI, both service and manufacturing, are, to say the least, not good. In fact, that word helicopter money is coming out that Milton Friedman named. And basically, it's central banks putting money out to the economy for the consumer to get. Now, there's different ways to do it with today's more modern terms, but you look for that discussion. It may come up. One of the ways, if the country itself isn't going to do it, maybe the European Central Bank does something to create this issue in some manner to get consumers to spend your way out of problem. Maybe Italy's not so wrong on what they're trying to do. When we look at a weekly area chart of closes for the S&P, as we come through today, you can see that the lead month was down 16 points so far. When we come to the December chart, you can see how the market is up at this point in time. And remember, that's a weekly chart. This is a daily. I don't know how they got that because I thought the SEP contracts all went off the board. Maybe there's a cash market they're looking at. I'm going to look into that myself. But you were up 7 points. The market had a break low back into the support level of the 2980 zone. The market held it and came up a bit, but are we trending? I've got to tell you, as much as we hear on TV, and we're within striking distance of all-time highs. The pattern, throw off the name, is still one of a lower low and a higher high. How do you change that? You can change this by getting tomorrow to be an up day. Then I can argue you've got, without taking out today's lows, higher highs, higher lows. That would change on the swing line. You're not there yet. You've got to not take out today's low on Tuesday. Did the market come down for the 18-day average? No. It just started going sideways, wasn't weak enough so far to get to that. I admit tomorrow's Tuesday. Tuesday reversals come into mind when you get an up day on a Monday. In looking at Bollinger Bands, they're very far away. The 30-50 area, you'd have to make new all-time highs to get to that. What's the importance? Bollinger Bands are an algorithm designed to keep the market trading within them 95% of the time. They offer you resistance and support levels. And what this market's done is it's trying to wrap its arms around price and come in. My guess is that number is going to drop tonight on the opening, and we'll see how much it drops. It's been dropping at about, well, when it did drop today, it was 7 points, but I can't say that that's what it's been doing because it had been moving higher. We're in that funny period here where this sideways action is catching up with the math. We'll see what it does. I'm bothered by something that happened on the chart. You lost the bullish momentum today on the close. In this December contract, you lost your embedded reading. You either gain it back right away tomorrow or this rally is false. And this rally says then price in the 18-day average are going to make a run at each other, at least from my theory on slow stochastics. Doesn't mean it's right, by the way. But the theory is if you lose the embedded reading and you can't get it back early on the second day, be very, very careful. And it is a warning shot across the bow that even though price is higher, internally momentum has waned. When I come to the Nasdaq, you can see how the momentum is pointing down. You got to the 18-day average and you held it, but I don't think this market's in a runaway mode in any manner. In the Dow, you lost the embedded reading. Yes, you closed higher by 69 points today, but you've got the swing line with lower highs, lower lows. Momentum on the slow stochastics pointing down. It's lost its embedded reading. It had lost it. If we take a look at Friday as well, it puts into play that price and the 18-day average are likely to hit each other. Now, it did make a run at it. You got to 26,803 today, and that number is 26,785. I don't think 17 points is close enough. Doesn't mean it has to be hit, but I don't think it's the same as hitting it. In the Russell, you can see how you've got the pattern lower highs, lower lows, momentum turned down. We have all the support area. Now, what I pointed out Monday through Wednesday, or I certainly began it probably on Tuesday, was once we got the crossover here. See how the 18-day average is meeting up right here with the 200-day average? Then the market got its crossover on Friday. This was the 20th. Now it's starting to move, as you can see. And if you get over this number and this market on a pullback holds all this, it's pretty bullish scenario, because you then have the 18-day average, the shortest term average, over the 100 in green, the 100's over the 200. The key is to have price stop declining and start moving back up. Can get very interesting in the marketplace. I had somebody write us and ask me about the VIX. Important to understand. I'm looking at the futures VIX, not the cash VIX. There's a difference in the two. One is based on the options area, the other is based on the futures area. I like this one on the futures, and I had the wrong one up last week. Not last week, I think it was the week before, to be honest. It should be the symbol VIXY, which is the cash VIX. When the futures expire, they all become cash. You can't deliver the product. But this is the one that I watch for those rules as to how close it gets to the Bollinger Band top or bottom. You're into an area of resistance of the 100-day and the 18. You can see how the market got up there today, hit 1600 as a high, 1609 is the 100-day, but 1582 was the 18-day average, and the market slipped back. This is the one that I want to use. The reason I didn't use it the week before wasn't an error. I couldn't get it through from the quote service. They had to do some repair. They had a glitch. In the T-bond market, all you did today is run back to that 18-day average of closes. What do we call the 18-day average of closes? The line in the sand. It marks, number one, for me, bias. When the market's under it, I have downside bias for my indicators. In other words, it's a filter on them. When I'm over it, upside bias. The first time you come down, it's not uncommon to fight a battle at the 18-day average. When you first come up from away from it, battleground right there, the line in the sand. What is this market? There is no trend. You have a lower low and a higher high. This still leaves this top overall in place. When you get to the 10-year note, momentum correcting an oversold condition, the rally getting right up to that 18-day average, missed it by 1.5 points today, so you're right in that zone. And while the swing line is up, that's pretty formidable resistance at this point. TLT, you came all the way from the lower Bollinger Band running it. Now the correction's carried right back, and you stalled at that line in the sand again. I'm going to repeat it, not trending at this point. Dollar index, not trending. You've got whipsaws day in and day out. You try to break out, you don't make any ground. You try to go up, you keep running into the Bollinger Band, not making any ground. This market is looking for a direction and doesn't have it. It still has the lower and low, higher high pattern. In the euro currency, once the news today came out on the PMI, you'd already been in lower high pattern and higher lows. I want to make that clear. You had this, the higher lows, the lower highs. So while the bias was down, and this was Thursday, the momentum was flat to pointing higher. Friday, momentum flattened out, maybe saying a little down, but the key was to get under this low back here, which the market hadn't done. It did it today. So now you're back into the lower high, lower low pattern. The trend is down. You've hit a downside target. I would expect resistance on rallies towards the 18-day average of closes, but I also think pros took some money off the table on the first challenge of the Bollinger Band. They've been fairly consistent at that, and you can see what the results have been. In the British pound, what are you going to do? You went up on Friday right into the first challenges of Thursday and Friday, the 100-day average in green, the upper Bollinger Band. That's where I think pros took some money off the table. You had an embedded reading that you lost on the close today. If you stay with that, the odds favor that you're going to have a challenge of the 18-day average of closes. I think the pros stepped out last week, not today, but today when you took out that break low, and you see this right here, you also broke the pattern of higher lows, higher highs. So the market got back to neutral territory. Now, the Japanese yen's an interesting one. The market had an embedded reading that it lost, not on Friday, today. If this market's going to keep it lost, it's going to get probably to that 18-day average of closes. Its first battleground's right where you're at, the 100-day. You can only get the embedded reading back the day after it's lost. So the fact that it's a 27 reading already tells me that the market's probably going to have to struggle here. Traders buying this yen, looking at PMIs, I'm thinking safe haven buying went on, and that's what got into the metals today too. In Bitcoin, down to the 100-day average, got through it here. Came back to the 18, down. It's still a pattern of lower highs, lower lows. It has hit its downside first target of the 100-day average, might hit the lower Bollinger Band, and the action stunk today. Certainly no safe haven buying with gold and silver. Then we get to the energy market that is staying on the differential, at least, between Brent and WTI. Still favors the Brent because the price is over that 18-day average of closes. When we take a look at November Brent, you can see how the market's got a pattern of higher lows, but lower highs. Do you see that? I'm questioning this market. Take out today's low, which was 63.54 of an outside day up. You put in the play coming back to the 100-day average. 65.57 was the number that you have to take out to put back in higher lows, higher highs. Do that, I think the bulls grab control of the market back. You're in a pause right here. WTI crude. If you look at today's break low, 57.37, it was under 57.50. Now, the momentum of the market is talking about the slow stochastic is neutral. The bias is up because you're over the 18-day average, but the trend is down. Lower highs, now lower lows. This market's battleground looks to me like it's going to be around the 56.97 level. I think that going home, nobody has control of this market. Gasoline, still higher lows, but you have lower highs. I don't think there's a trend at work here. Momentum is flat, the bias is up. Natural gas gave everything up from this high. Now we were talking, we're going to get to that time of year also, right? Where you don't need heat, you don't need air conditioning, and that starts weighing on this market because we're entering fall, which we're now at. Momentum down, you have hit your first downside target. The 18-day average when you lost right here, the embedded reading, it puts into play getting to the closest of the main averages, which is the 18. If it doesn't re-embed the very next day, this was Thursday, it did not re-embed the next day, so that gives you this action today, and now the question is, what's next? You've got two levels of support, and selling it short here, you got a heck of a risk if you put it over the high, so that's your question mark. What do you do? One of the things that I use when I'm looking at these energy markets and the other parts of these financials is I go to the Moore Research Center, and I've been a subscriber to this. I'll bet it's 3 decades, 30 years. I don't know when they began, but I've always believed that certain events happen over and over. Think of the planting of grains, the harvest time of grains, what goes on. Well, financials work in that arena to a degree too. And what they do is seasonal patterns. So they'll go back and their databases are looking day by day through the futures and cash markets as to what's going on. And believe it or not, they publish daily. It comes out every month, but you get buy here on this date, sell here on that date. When you do that, there's a caveat. They're the first to tell you in their own report. Use other technical indicators with it. Know the environment you're in. It is a trade tool, and at the end of the day, if history could predict the future, you know where we'd all be. It doesn't. History is a tool, and past performance is no guarantee of future performance, but it should not be ignored. And I do look for it because you get funding operations in markets, you get other parts that come in the financials. They are important. And as bearish as everybody on TV was in the first part of September, their work was saying long the stock indices, and it caught a great part of that, and then stepping out at a certain point, and you're waiting for the next break point. I already know what it is, but if you want to know, all you've got to do is go to our website, free offers, sign up for this. We'll make sure you get it. Then you could see for yourself what they say. You can always click here if you're watching us on YouTube. It'll take you to that sign up page, or you can give my staff a call during business hours. I'm Ira Epstein. You have a good day, and I'll talk to you tomorrow.